So I suspect by now you're probably asking the question, how do we make sure the balance sheet always balances? Well, in essence, we need to make sure that every single accounting transaction, when entered, is balancing the balance sheet. When the transactions are recorded in the financial records of a business, we use something called double entry accounting, or sometimes called double entry bookkeeping. Let's see how that works. As we know, assets are made up of things a company owns. That can range from the most liquid being cash to the least liquid being what we call fixed assets or capital assets. Capital assets include vehicles, equipment, building, and land. Now, capital assets or fixed assets are things the company uses to generate its returns. Capital assets are not the things that a business typically sells on a regular basis. If a company worked in the business of selling vehicles, we'd actually call those vehicles inventory rather than capital assets. Now, the asset accounts are listed in order of liquidity. We start with cash, which is the most liquid, and move down to the least liquid. Generally, land and buildings are more difficult to liquidate than vehicles or inventory. Now let's look at the liabilities. Liabilities are listed in the order of the maturity. That is, when do they have to be paid back? Remember, liabilities are what a business or company owes. Now let's turn to the double entry bookkeeping. Asset accounts normally have what we call debit balances. DR is used as the shorthand for debit. This means that when recording transactions related to asset accounts, we debit the account to increase the balance, and we credit the account to decrease the balance. Now, CR is often used as the short form for credit. Now, in contrast, liability accounts normally have what we call credit balances. This means that when we increase a liability, we'll have a credit on the account, and if a liability is decreasing, we will debit it. Finally, we have equity accounts. Equity accounts are further broken down into revenue and share capital. Those accounts have normal credit balances. Equity accounts also include all expenses and dividend accounts. The increase in these accounts has a negative impact on the overall equity, so they have normal debit balances. The higher an expense account or the more dividend paid, the less equity remains in the company. Okay, now let's practice with our debits and credits. I have two practice exercises for you. I have one called Practice 1, which we'll do together right now. And then Practice 2, I'm going to encourage you to do it first. And then when you're ready to debrief, click on the next lesson and I'll debrief that practice exercise with you. Okay, so let's get started. You'll see at the top, I have put here a bit of a cheat sheet in terms of whether something is an asset, a liability, or equity, and what we do if we need to increase or decrease one of these. And so we have assets, of course, things we own, liabilities, things we owe, and then we have equity. And we call that equity has share capital or common shares, but it also includes our revenues and expenses. So the first question we always ask is it an asset, liability, or does it sit with an equity? So we have scenario 1 where we increase cash. Well, cash is an asset. It's something we own. And now that we know it's an asset, when we're increasing an asset, we know that the rule is it's a debit. Next, we have increasing a vehicle. Now, a vehicle is another thing a business or organization can own, so it's an asset. And again, we have increases to this asset, so it's a debit as well. Okay, let's go to the third one. Now we're increasing a loan. Now, a loan is something we owe, so it's a liability. So let's just capture that it's a liability. And when we're increasing a liability, we credit the liability. When we increase share capital, we know that's part of equity. And when we increase share capital, we are also doing a credit. Now we have one more thing. When we increase an expense, recall that expenses are falling under equity as well. But when we increase an expense, unlike increasing revenue or increasing shares, it is a debit. Okay, so we've had a go together. Now turn to practice exercise 2. I'll just click on that now. Have a go through those 5 scenarios. And once you've had a go, then click on the next lesson and I'll debrief it with you. Bye for now. Well, now let's debrief practice exercise 2. Again, we have the cheat sheet at the top if you need it. And the first question always to ask, is it an asset, a liability, or equity? And then we can think about whether we need to do a debit or a credit. So scenario 1 is we decrease cash. So what is cash? Well, we already know from the first practice exercise, that's an asset. And when we decrease an asset, we credit it. Next, we decrease a loan. Now recall, a loan is something we owe. It's a liability. And we're decreasing a liability, so that is a debit. Now we go to increasing revenues. Recall that revenues falls under equity. And when we increase revenues, that is a credit. Number 4, the fourth scenario is we're decreasing equipment. Now, equipment is something a business can own, so it's an asset. But we are decreasing equipment, so that is going to be a credit. And finally, we're decreasing share capital. So for example, maybe an organization or company is buying back its shares. When we decrease share capital, we know that's part of equity. And we know, therefore, that is a debit. Congratulations, we've now had a bit of practice with debits and credits. Okay, now let's dig a bit deeper and record some actual company transactions using the double entry accounting system. So let's imagine that a business or company engages in the following transactions. First, the company wants to raise money to get their business going, so they issue shares for $100,000. In addition, the company takes out a 4-year loan for $50,000. This is just another way to bring money into the company and finance the company. Now, using that money, the company goes out and buys equipment and machinery for $80,000. The company also buys inventory for $6,000, but it then sells all the inventory for $10,000. Now, during the period, salaries of $1,000 are paid, and interest of $500 is also paid. So, how would each of these transactions be recorded in the accounting records? Let's start by looking at what happens when a company issues shares for $100,000 in cash. First, the company's cash balance increases from 0 to $100,000. This is recorded as a current asset on the left side of the balance sheet. Now, to ensure that we are constantly balancing, we would have to record a transaction on the right side of the balance sheet as a liability or equity. Alternatively, we would have to record a negative number on the asset side of the balance sheet. In this instance, we record $100,000 next to common shares under equity. The balance sheet balances. Assets equal total liabilities and equity. Now let's look at the same transaction from a debit and credit perspective. Remember that increasing assets is a debit. Since we added $100,000 in cash, which is an asset, we debit cash. The increase in equity, you may recall, is recorded as a credit. The key thing here is that our total debit have to match our total credits. That's the accounting equation, that assets minus liabilities and equity still actually holds. In this case, we have $100,000 equaling $100,000. Now let's look at a second transaction. Let's see what happens when the company takes out a 4-year bank loan of $50,000. We saw that a company can raise money by issuing shares, but companies can also borrow money from financial institutions. In this instance, the company is taking out a 4-year bank loan of $50,000, so our cash will go up by $50,000. Recall, cash is an asset, and because it's increasing, we're going to debit cash $50,000. We also, though, now have an obligation to pay the bank in 4 years, $50,000. So we have something we owe, and that's a liability. And when we increase liabilities, we credit them. So we are going to debit cash $50,000, and we're going to credit loan payable $50,000. Again, the total amount of debits and credits cancels each other out, and the balance sheet continues to balance. Before going to the next transaction, one thing I want to draw your attention to is the identification of accounts that are either current or non-current. I mentioned before that assets are listed typically in order of liquidity. Current assets are those that can be liquidated quickly and used by the company in the short term. Companies expect to use these assets within their current accounting cycle, or typically 12 months. I also mentioned earlier that liabilities are ordered by their maturity or due dates. Current liabilities are those obligations that a company must meet within the short term. Again, that is usually during the current accounting cycle, which is typically 12 months. Because this is a 4-year loan, it's considered a non-current liability. So now let's move to our third transaction. Let's see what happens when the company uses its own resources to buy $80,000 of equipment. So here's an example of one of those transactions that impacts only the left side of the balance sheet. Remember, as long as the total debits equals the total credits, the balance sheet will continue to balance. In this case, the company is using $80,000 of cash to purchase equipment. You can think of it as swapping one asset for another. The company gave up cash to gain equipment. Now equipment is an asset, and we're increasing equipment, so we debit the equipment account. Cash, we know, is also an asset, but in this case, we're decreasing an asset, so we credit cash. The next thing the company needs to do is buy $6,000 of inventory, which it intends to sell. Again, we are swapping one asset for another asset. Inventory is a current asset that is increased, so we're going to debit that, and cash has decreased by $6,000, so we're going to credit that. You can see that the balance sheet still balances, and total debits equals total credits. So far, we've seen what happens when we make adjustments related directly to the main balance sheet sections. So we've seen the company, for example, add equity and liabilities, and we've seen several adjustments to our current and non-current assets. Now, although we would normally record transactions related to income and expenses on the income statement, it's critically important that you understand how that impacts the balance sheet. Previously, we discussed the different types of accounts and their normal balances. When we got to the equity section, you might recall we had a few different accounts that had different balances. Overall, equity should be in a credit balance. It resides on the right side with liabilities, which also typically have credit balances. However, equity is made up of a number of different accounts related to revenue generation and common stock. Now, if you recall, I mentioned that revenue and shareholder contributions, also known as common stock or common shares, have credit balances. They increase equity. So, for example, as the company generates more revenue, the value or equity of the company goes up. Conversely, expenses and dividend payments bring the value of the company down. The more expenses the company incurs, the lower the equity. Okay, let's move to the next transaction where we see the company sell all the inventory for $10,000. So far, our debits and credits have been just one debit with a matching credit. In this instance, we're going to have two debits and two credits. So it's a bit more complicated, but don't worry, I've got your back. So I typically like to start with cash. What's happening with cash? Well, cash is increasing by $10,000. So increasing an asset is debit. So we debit cash $10,000. But we also have generated revenue for our business. Recall that revenue is under equity, and when we increase revenue, it's increasing equity, and so it's credit revenue $10,000. So far, so good, our balance sheet balances. But we also have to deal with the inventory. We no longer own inventory as we sold it all. So we decrease an asset, which is a credit. So we credit inventory $6,000, but we then need to debit something else. Now, inventory expense is referred to as cost of goods sold, and we know that expenses sit under equity, and that if we increase an expense, it's a debit. So the second part of this transaction is debit cost of goods sold, which is an expense, $6,000, and credit inventory $6,000. The good news is our balance sheet continues to balance. Okay, here's our next transaction. Now we want to record the company's $1,000 in salaries. Part of the day-to-day operations of all companies involves incurring operating expenses. Companies hire people to perform certain tasks and in return pay them a salary. In this case, the salaries paid amount to $1,000. So we're paying them with cash, so we're decreasing an asset. So that would be credit cash. And we also need to increase an expense, and we know that's a debit that sits under equity. So we have debit salary expense of $1,000 and credit cash $1,000. Keep in mind we're still using the double entry bookkeeping system, and our accounting equation remains true. Assets of $153,000 are equal to liabilities of $50,000 and shareholders' equity of $103,000. Okay, we're almost there. There's just one more transaction. We need to record $500 of interest that the company needs to pay for its bank loan. Banks obviously don't provide funding without a cost. Instead, they charge interest typically based on the outstanding loan balance. In this case, we're going to assume that the company needs to pay interest immediately of $500 on the loan balance. So what do we see? First of all, we have to pay it out of cash, so we decrease an asset. And when we decrease an asset, we say we're crediting it. We credit $500, but we also now have an interest expense. And that interest expense sits under shareholders' equity. And remember, interest expenses are debits. So we debit our interest expense $500 and we credit our cash $500. And good news, the balance sheet continues to balance. The accounting equation holds. Let's construct a balance sheet together for a company, a fictional company that I'm going to call Nairobi Trading Inc. We are going to do both the journal entries, the debits and credits, but also build up the balance sheet. So if you haven't downloaded the spreadsheet already, please do and follow with me. You can always speed me up or slow me down. Okay, so let's get started. We're going to record 5 separate transactions. The first transaction is we have issued common shares of 500. So let's start with the journal entry. I always like to start with cash. And if we say what is cash, cash is an asset. And when we increase an asset, that is a debit. So we know we're going to debit cash 500. Now, the nice thing about a journal entry is we know it has to balance. So we know that the other entry has to be a credit, but we also know that when we increase equity or increase common shares, that is a credit. So we are going to credit common shares 500. The journal entry balances. Now let's move down to the balance sheet and update the balance sheet with this transaction. Okay, so here we have the balance sheet, and we've said cash increases. I'm going to use an equal sign. You'll see why later, so that I can record each transaction and have a trail of all the transactions if I need to figure out something that might not go right or wrong. Okay, so there's the cash, it's 500, but we also know we have shares that are 500. And our balance sheet balances, you probably can see here at the bottom, there's a nice little check. So you can see if it doesn't balance, what the difference is and investigate where that difference might be. Okay, that's the first transaction. Let's go to the second transaction. We bought equipment for 300 with cash. So here we have equipment, which is an asset going up, and we have cash that's an asset going down. So let's start with cash again. Recall that when we decrease an asset, it's a credit. So we're going to put 300 there, but then we're increasing an asset, which in this case is property, plant, and equipment, and we put 300 there. Our journal entries complete, our debits equal our credits, and now let's move to the balance sheet. Okay, so we are going to take 300 out of cash, but we're going to add 300 in property, plant, and equipment. The balance sheet balances, we can move to the third transaction. Our third transaction is we bought inventory of 100. Now, 80 of this was with cash, and the remainder is outstanding at the balance sheet date. In other words, we owe our suppliers 20. Now, we know that when we owe something, that's a liability. And when we owe something to our vendors or suppliers, we call that accounts payable. So let's do this transaction. We're going to start with cash. Now we are decreasing an asset, which is cash, so that's going to be a credit. We're buying inventory, so we're increasing an asset, so that's a debit of 100. And we have to deal with that 20 that we owe to our suppliers. Remember, that's a liability. We're increasing a liability, so we know that's a credit. And we also know it has to be a credit for the journal entry to balance, and that's accounts payable. Now let's put that on the balance sheet. So we're going to start with cash. And recall that we have paid for 80 of the inventory, so we're going to go minus 80. But we also have our inventory going up, and that is at 100. Now, you can see we're out by 20 if you look at the bottom of the balance sheet, and that's, of course, because we haven't recorded what we owe to our suppliers or accounts payable. When we increase a liability, that's a credit. We put our accounts payable at 20 and our balance sheet balances. Now, let's move to our fourth transaction. Our fourth transaction is going to involve a number of elements. So we sold 75% of the inventory for 120. Now, 100 of this has been received in cash at the balance sheet date. But in other words, there's still 20 that is owed to us from our customers. Now, when our customers owe us something, that's an asset, and we call that accounts receivable. So now let's do this transaction. I'm just going to scroll down. Okay, so we have actually got cash increasing by 100. But recall that we sold 120, and 20 is owed from our customers as accounts receivable. That's increasing an asset, so we put our 20 there. We also have revenue increasing. Remember that revenue is in our equity, and when revenue increases, that's a credit. Now, our journal entry balances, but we haven't done the full transaction because we've recorded the revenue from selling the inventory, but not the expense of buying that inventory. So that's what we need to do next. So what's happened to our inventory? Well, we've sold 75%. So we're decreasing an asset. Remember, when we decrease an asset, that's a credit, and that's 75 or 75% of 100. But we also now have an expense. Recall that when we increase an expense, and that falls under equity, that is a debit. And that cost of sales or cost of goods sold is there, and our journal entry balances. Now, let's go back to the balance sheet and make sure we can update the balance sheet accordingly. So I'm going to start with our cash. Our cash goes up, recall, by 100. But also recall that we have some customers who haven't paid us yet, and that is 20 in accounts receivable. Next, what we have our revenues of 120. But now let's deal with the inventory. So we know there's a cost of sales, and we know that's 75, and that's an expense, so we're going to deduct it. But we also know that means our inventory, we're decreasing that asset also by 75. Our balance sheet balances, so we are good. Now let's go back up for one more transaction. And here we paid a cash operating expense of 15. So I'm going to start with the cash. What's happening with cash? Is it going up or down? It's going down, so we know cash is a credit, and that's 15. But it's also an expense. And recall that when we increase an expense, that's a debit. We also know that the journal entry has to balance. Now let's put that final entry on the balance sheet, and we will be done. So we have an other operating expense of 15, but we also paid for that with cash. So our cash is going to go down by 15. Our balance sheet balances, congratulations. Now it's your turn. Have a go at the next activity. Download the sheet and see if you can complete the balance sheet. And then once you've had a go, click Next, and I will debrief the activity with you. See you in a few moments. Okay, now let's go through this again with a separate fictional company that I'm calling Cairo Trading Inc. This time around, we're not going to do both the journal entries and the balance sheet. I'll talk to the journal entries, but we're going to go right to the balance sheet. So let's work through these 5 transactions together. Let me get my mouse and my cursor so we can work through those transactions. The first transaction is issued common shares of 300. Now we're going to start with cash, and recall when we increase an asset, that's a debit. So we debit cash, or in other words, increasing cash by 300. But we're also increasing equity, which is a credit. And that's going to be equals 300 as well. The balance sheet balances, we're good. Now we bought equipment, which is an asset, for 200 with cash. So we have equipment as an asset going up, which is a debit, and we have cash, which is an asset going down, which is a credit. So what we're going to do here, I'm going to start with cash again, and I'm going to minus 200. But we also have to create an asset of 200 under property, plant, and equipment. Good, our balance sheet balances. So now let's move to transaction number 3. Here we bought inventory 50. 30 of this was paid in cash, but the remainder is outstanding at the balance sheet date. Now, in other words, 20 is still owed to our suppliers, and we call that liability accounts payable. So let's actually start with cash. So we're going to take 30 off because we're decreasing cash, so it's a credit. But we're also increasing inventory, so that would be a debit of 50. And we have 20 that is owed to our vendors or suppliers. So let's put the 20 there. Our total assets equals our total liabilities and equity, so we are good to go. Now, let's keep moving on. If we now actually sold 50% of inventory for 75, and 65 of this is being received in cash at the balance sheet date. So I'm going to start with cash, and I'm just going to scroll up so that it's very clear what's happening. So what we said is we actually made revenue of 75. So I'm going to start there. Of that revenue, we got 65 in cash. And we have 10 that's owed from our customers, and we call that accounts receivable. It's an asset. We're increasing that, so that would be a debit. So far, so good. Our balance sheet balances, but we also have to deal with the cost of the inventory. Remember, the inventory cost us 50, and we sold 50% of it. So we know our inventory is going to go down by half, or 25, but we're also going to have a cost of goods sold, or cost of sales expense of 25. Recall that increasing expense is a debit and decreasing assets is a credit. So our debits and credits still match. And our balance sheet balances. Now, there's just one more expense, and that is we paid a cash operating expense of 5. So let me go to cash first. I'm going to take off the 5. And then I'm also going to have to increase an expense, which is a debit. We're going to go minus 5 there. Our balance sheet balances, the accounting equation holds, and congratulations, you've entered some more transactions and built a balance sheet from scratch. Now let's explore different layouts of the balance sheet. In different parts of the world, the balance sheet will be laid out slightly differently. The same information is there, but just the layout is different. So to give you a couple of examples, I thought I'd share with you a US typical balance sheet versus a typical UK balance sheet and a typical French or German balance sheet. And the key thing is, as an analyst, you want to be mindful that the same information is there, it just might be laid out slightly differently. So what we have been building so far is a balance sheet that is laid out in a format that we typically see in places like the US and Canada. We start with our assets, and we go from our most liquid assets, which are current assets, to our least liquid assets, which are things like property, plant, and equipment. We then go to our liabilities, and they are organized as well by most liquid to least liquid. Now, when I use the language of liquidity, what I mean is how easy is that asset in terms of turning it into cash. So the most liquid, of course, of assets is cash. The most liquid of liabilities, the most likely to be turned into cash are things like accounts payable, because we have to pay our vendors typically in a matter of weeks or months. So this is what we've been working for so far. Let's now look at how the same information might be presented in the UK. So again, the balance sheet still balances, but it is very common in the UK to start with your assets, similar to what we see in the US and Canada, but to start with the least liquid. So here we're starting with non-current assets, and then we move to current assets so that cash, the most liquid asset, is the last asset listed. But you see, we don't have total assets. In the UK, it's common to then go to liabilities and start with current, the most liquid liabilities. And so we see, very similar to the US and Canada, the liabilities are ordered from most liquid to least liquid. Now, one of the benefits of a UK balance sheet is that you can actually net off your current assets and your current liabilities. We call that net current assets. And what that tells a reader of financial statements is, are there enough liquid current assets to cover our liquid current liabilities? So it's called a coverage ratio, or sometimes a working capital ratio. So it's a quick way to see, do we have enough cash and other liquid assets to cover our liabilities that we're going to have to pay in the next 12 months? And in this case, we can see that number is always positive. So we'd interpret that as a positive sign. We won't have any problem paying our current liabilities. We then look at our non-current liabilities, which is long-term debt, and we get something called net assets, not total assets, because remember, we're netting off our liabilities. Now, the balance sheet has to balance, but we haven't looked at equity yet. So what we are doing is we have our net assets, which is really total assets minus liabilities. Recall that the accounting equation means that that all still has to work. And you can see, therefore, it must match total shareholders' equity. So that is a common UK balance sheet format that you might come across. Now let's look at a typical French balance sheet. Here's the same information. Again, the key thing that I want to share with you is, don't worry if it's laid out differently. You can still find the same information. So in France, it's quite common to see assets organized by non-current to current, so least liquid to most liquid. But liabilities are ordered in the same way, least liquid to most liquid. So you can see our current liabilities are captured there. Our assets still match our total liabilities and shareholders' equity. The key difference between a French balance sheet and a US balance sheet is just the order from current to non-current, or non-current to current.